Hey everyone, so we are live today with Mr. Clyde, the mortgage guy. Clyde, how you doing today?
I'm doing really well, Terry. How about yourself?
I'm super excited to be here. So today we wanted to do a quick little question and answer, just between us for now. We're not inviting participants on this call, maybe on the future one, but just to get some questions that I get a lot answered. Clyde, you want to tell us about yourself and who you're with?
Cool. Yes. So my name is Clyde Penton, as Terry said. Clyde the Mortgage Guy. That's how quite a few folks know me. I am with American Pacific Mortgage, and I've been in the mortgage lending business for going on 16 years now. And yeah, just really enjoy being able to help people. That's really the thing that I find interesting, and I enjoy the math about it too. But yeah, really enjoy helping home buyers, and moreover helping folks use their VA home loan benefit, so veterans and active duty military folks that are eligible for VA loans, and then yeah, helping folks with some of the down payment assistance and first time home buyer options out there too. So yeah, I appreciate you having me.
Yeah, definitely. So things have changed a lot over 16 years, right?
Yes, they have.
Constant change. Well, listen, today I really wanted to focus on some questions that I get a lot. And
Okay.
of course, I feel like I could answer it, but I think we need to have a professional truly answer the questions. So
Gotcha.
we'll go a little bit around the world. So one question that I get a lot is, I may be approved for, let's just say $200,000, right? And I'm looking for a house, but I can't find it. And I found one that is only 160,000. Can I take the difference, that 40,000, and use it towards repairs on a house with a standard loan?
So you can't take it and do that with a standard loan. The most that you could realistically use, and this would be something that would have to be set aside by the seller or by yourself, probably by the seller if you're buying a property, would be what's called an escrow holdback. And you may be able to get that for anywhere between $5,000 and $10,000. And what that is funds are held from either the buyer or the seller in an escrow with the title company or attorney. And when the work is complete, the funds are released from the escrow account when it's confirmed that it's been done. There's a better way to do that though, especially if you're talking about making use of $40,000. So.
Okay, what does that look like?
Cool. All right. Didn't know if you were going to go into the additional questions, but yeah, we'll roll right through. So actually, there are three different types of what are called renovation loans. So these renovation loans actually will allow you to get funds to complete renovations or actually remodels of a home, if you will. The three different ones I mentioned here, I say the three different ones, there's actually four, but one of them is two of them are with conventional loans. So those are going to be pretty similar. That is through Fannie Mae. There's the home style renovation loan. With FHA, it's called a 203K. That's one that's probably gets the most conversation, or that people think they've heard about somebody that did one, is the 203K with FHA. And then there is also the VA renovation loan. So actually VA allows a renovation loan to be done as well. They're a little bit more involved than a straightforward loan. You have to have an approved company or an approved contractor, depending on the amount. 40,000, you may have to have a HUD certified project manager, basically. Yeah, HUD certified project manager to actually oversee the renovation work to make sure that it's being done correctly to code, all those types of things. They don't want to put anybody into a bad position where you buy a money pit and it stays a money pit instead of actually becoming a great home for you to live in, which is the goal of using the program, right? So, but yeah, so there's those three different types of loans that would be much better if you're talking about 40,000. You would want to, yeah.
Well, ideally, if I'm thinking that I want to go that route, I need to apply for that type of a loan specifically, right? Just because I get approved, I can't automatically jump into that.
Correct. Yes, ma'am. Yeah, there are definitely differences in your ability to get approved. There's usually going to be a little bit of a difference in the interest rate, and that could determine whether you do get approved or you don't get approved, right? Because the interest rate would cause you to have higher debt ratio. So your debt ratio is when you have your expenses versus your income, right? So your gross income, actually, and then you take your credit-worthy expenses. So things that are actually on your credit report or things that you owe another like human being or the government. We're not talking about utilities, but if you have like an IRS debt that you're paying,
Yes.
that goes on your debt ratio.
Okay.
If you have child support or something that you pay as part of a maintenance agreement from a divorce, that needs to go on your debt ratio. But your utilities, water, gas, electric, those things do not go on your debt ratio. So just be aware that when you're looking to qualify for these things, make sure you have the right program, because that could affect your interest rate and or your costs. Sometimes those programs, they may have a similar rate, but there may be like points or discount costs, like an actual cost to you for them.
Jumped into calculating, that's what we call the debt to income ratio. What about say car insurance, things like that? Those don't count, right? It's just stuff that
Car insurance does not count. Yeah, car insurance does not count against your debt ratio. Yes, if it does not report again to the actual credit bureau, so cell phone doesn't count, car insurance doesn't count. Where those things come in handy though is if you need to do what's called non-traditional credit, like if you don't have a lot of credit but you pay rent on time and you want to try and get a mortgage, you can use car insurance and your cell phone bill and utilities for building your credit report that way. So that's good.
Wow, that's really good to know. So with that, if I have to go that route and they're looking at it, it's not reporting on the credit. So how do they look at it? Like, how do I have to prove that I paid that?
So non-traditional credit, actually what you would do is you would provide a history of payment or a letter from the company that you pay it to showing that it's been paid on time, that it's not been late for the last 12 or 24 months. And then we can actually take that and we can get it supplementary added to get a supplementary credit report, get it added as a supplement to your credit report. Actually, the agency we use, they've got literally a little button to click and add supplemental trade lines to on their front page of the report. Yeah, not all of them do, but this one happens to. So
yeah, that's a pretty good option. And just so we kind of hone in, I think I know the answer to this, but again, I'm asking the professional. If we say late payment, like what if I paid my cell phone bill like 4 or 5 days after the due date? That's not late, right?
no, that is not considered late. Yeah, 30 days late.
Okay.
So the actual question, I will tell you though, when you ask some of these folks to fill these things out, sometimes they get a little, we've done verifications of rent, they're like, oh, they were late. They were late every month. And I'm like, but the question asked, were they 30 days late? I didn't ask for your opinion about lateness. We asked specifically, so some people get out of hand, you know, some people are people, you know, some people are people. Yeah, people are people. Oh goodness. And this one was from New York. They're like, oh, I can't change it. It's against the law. I can't change it. I've already done it. Okay. Right. I mean, but you didn't answer the question correctly. But nevertheless, yeah. So yeah, it doesn't count 4 or 5 days late unless there's something that goes on your credit. Now, that's not to be confused. I did have a person one time, they're like, oh, it was only just a couple of days late. No, it was 32 days late. They got that mixed up too. So
Right.
yeah. That's late. Once you hit 30, it's going on your credit report. 31, it's going on your credit report. So
Gotcha. Okay, so we've touched just basically on no, you really can't use the difference if you're only approved for a standard FHA loan.
right.
But if you're interested in buying a house that may possibly need repairs, then they can just automatically qualify for that 203K or the VA, whichever other loan. So that's awesome.
Yep.
Then let's ask another question. So
Sure.
I get a lot of people being down here in Alabama that own land. Maybe they've inherited it, or we get some really inexpensive parcels for sale and they'll go buy them. But there's different types of loans for those, right? So it's not like you're going to go to a builder who's already built a house. I own the land and I want to put a house on it. How does that work?
So there's a couple of different ways that can work. And really good question, because yeah, there's definitely folks that are out there buying land. That is a thing right now. I think they think it's going to be better for them, and I'm not saying it won't be. I'm not saying it won't be. But what are the costs? What are the costs to build where you are? What are you seeing builders charging right now per square, just for basic?
You know, it's quite funny because it's going to depend on the county, of course. If I have the land already, I think they're somewhere in the 145 to 165 a foot. I can do construction house for that for cheaper than that, and it's already there.
Sure. Yeah, that's kind of the thing that's interesting, because when they're building 50 or 100 units or 30 units in one space, their time and their costs tend to be a little bit less, they've factored in that. But nevertheless, back to your question, sorry, throwing the extra piece in there. If they own land, what they need to do is they need to qualify for a construction loan. Now, the good thing is there are lots of construction loan types. There are USDA construction loans. There are FHA construction loans. There are VA construction loans. There are conventional construction loans. And as you would imagine, USDA doesn't officially require a down payment. Now, that doesn't mean you won't need some money. Or if you own land, right, you can own the land. If you own the land already, right, you can possibly use the land to cover your costs, right? Because it's going to end up being a loan to value thing, not, oh, I can get 100% of the cost to build, right? There's still going to be your costs that you have to pay up front. Like with VA, it's really interesting. There's like a management fee for the construction, for the oversight, and all the title updates and the draws and things like that. But you cannot pay interest on the loan on a VA construction loan. So that interest is actually paid up front, but it's part of the management fee. So it all ends up, really, the home has to appraise for the value, right? So it has to be figured out in there somewhere. But you don't have to make interest payments during the process. But yes, really good question, because all of those, even manufactured homes, modular homes, all those things actually qualify for construction loans as well. So if that may be a better or more affordable route for some people to go, then by all means, they could take a look at that as well. And similar things to the normal guidelines for those who are going to apply. A little bit more involved, have to make sure the builder gets approved. So they have to be somebody who actually builds homes. They've got to be licensed. They've got to be able to, show that they've built a few homes in the last year, things like that. But yeah, every one of those programs allows it though. So if they've got a nice little homestead in the country, or a little land that could be a homestead in the country, yeah, they can get a modular home or build a home, any of those things with any of those loans.
Credit score for that type of a loan? Is it like the same 600-ish, or does it have better requirements?
No, so usually a little bit higher credit score. There's one outlet out there. I don't personally deal with them at this time, but 640, you can get a construction loan. If you qualify, right? 640, 660, 640, 660, 680. There's like levels to it.
Okay.
We actually do construction loans in-house.
Okay.
But then we also have some outlets where we can do one-time close with a couple of other companies that we're partnered with. So yeah, we've got 2-time close, 1-time close. Yeah, both of those are available options. So we've got quite a few construction things actually.
I think that's a really good topic right now, because like you said, a lot of people do have the land. We have the shortage of inventory. The builders aren't building as fast as we would love them to build, but there's an option. So that's always good. And
absolutely.
You'd want to come and chat with me so that I could give you my advice, and then we'd get you a wonderful lender like Clyde, so that he can give you the real deal on the mortgage side of that part.
Absolutely.
Cool. All right. So I'm not going to take too much of your time, but this is another big one that I'm getting asked a lot. So there's when you own a house already, it's yours. Right now, over the last 2 years, we've built a lot of equity in those houses, right? So people are looking at how can they keep their house, but maybe cash out that equity and do whatever they want with it. There's a difference in the ways you could do that, right?
Absolutely. Yeah, there's a couple of different ways that you could tap into that. Probably 3, honestly, but 2 that I would talk about as a mortgage professional. One of those is doing a refinance, where you would do what's called a cash out refinance. Now, depending on your current interest rate and what you're planning on doing with the loan, or what you're planning on doing with the funds, would really determine on which option's best for you. So you've got a cash out refinance, where you refinance the whole thing, right? And then you can look at what's doing a HELOC, a home equity line of credit. What it means is you are getting a line of credit on the equity in your home, right? Home equity line of credit. So you are getting a line of credit, which is similar to a credit card, but it is attached to your home. So you can get a second mortgage. So let's say you bought a place for $200,000 and now it's worth $300,000, and you want to get some of that money out, that $100,000 in equity, right? So with a HELOC, depending on your credit score, you do have to have higher scores typically for those, anywhere between 660, 680, 700. We actually do those with our company. We provide them, but we have some other outlets, or I may even refer somebody to for a HELOC, just depending on the situation, to another bank or a credit union, another loan officer. But a HELOC, you're only tapping into the portion that's in the 100,000 portion, right? So you could get a $40,000 line of credit there, or maybe 50 or 60 or 70, just depending on how, how your credit score is and what your debt ratios are, right? So you could do that. You could do a home equity line of credit. You keep your first mortgage in place and you take that second home equity line, right? And you can use that to whatever you like, right? Start a business, pay off other debt, buy a car, buy a boat, whatever you like, right? If it works for your tax situation, it may be really beneficial because you may be able to deduct that from your personal taxes, right? Again, not a tax professional, so I'm not saying you can do that. What I'm saying is that you may be able to. So talk with your tax professional or review your tax laws, the code, to see if that works for you. The refinance, you'd be refinancing the whole thing. May be helpful for you. If you've got, a rate that's X and it would only go up 1 or 1.5%, that may be okay. The way that you really want to crunch those numbers, and this was really big back when homes were being bought with 0 down back in the mid 2000s, you would get what's called an 80-20 loan. 80% first mortgage, 20% second mortgage. Those were super common back then. Sounds kind of crazy now, probably to most people, but you could get a loan with no money down, 580 credit score, stated income, like didn't even verify income. Really kind of bananas in retrospect, just thinking about it, to be quite honest with you. But nevertheless, we would do what's called a blended rate.
Okay.
So you take the first mortgage rate and the second mortgage rate. So 80-20, it would be like 4-1, right? So if you have a 5% first mortgage, that's 20. And a 10% second mortgage, the total is 30, right? Then you divide it by 5. So your average interest rate is 30 divided by 5 is 6%, right? So 5%, 10%, your average rate between both of them is 6%. So that's really the way that you want to look at the blended rate and see, oh, okay, cool. If the blended rate is actually lower by refinancing the whole thing, that's probably the way for you to go. The other thing for you with a HELOC is that you do not have to use the money immediately. You don't have to use the money immediately, and they're usually a little bit less expensive.
Okay.
So refinancing $250,000, you're going to have things like title insurance, and the Uncle Sam,
Yep.
or Uncle whoever you have, Uncle Bama, Uncle Georgia. They want to get their taxes for the refinance and mortgage and those things, so they get those. So those tend to be less with a lower loan amount, and even second mortgages sometimes don't have the same things applied to them. So could be, you could look at that cost as well. But biggest thing probably is the use of the money if you're going to use it immediately, and what the blended rate would be. If the blended rate's lower, refinancing the whole thing, that may be a good option for you. But that's the thing that you can look at for yourself. The blended rate. Talk to your person you're working with about that. If you have questions, reach out to me.
Sure. So basically, if I was lucky enough to get one of those 2 or 3%, but I want to take that money, it might not be smart for me to do the whole refi. It would probably be smarter to look at just a line of credit.
Correct. If you can get a line of credit, that's probably the way for you to go. A line of credit right now, depending on your credit score and what loan to value. So again, 100,000. If you got 300,000, you owe 200,000. If you go to 240, that's 80%, right? Combined loan to value, because 80% of 300, right? But if you're going higher, it may be a little bit more expensive. But what HELOCs start off with is prime. So right now, prime is what, 7.25, I think.
Okay.
You'd be prime or prime plus 1, so you'd be 7.25 or 8.25. So just know, that thing. But if you got a 2.5 rate, you probably don't want to touch that unless you were just taking money out. Yeah, unless you get a VA loan that's still at a really good rate and you're paying off a ton of credit cards or something. Like if you're just paying off a ton of stuff that has really high interest rates,
Rubbing our crystal ball.
chances are you want to look at a HELOC. Yeah.
All right. So, well, listen, I think all of this has been really helpful information, and I thank you for taking the time to do it with us. Anything else you want to throw out there about you or how to get in touch with you if they need to?
Yeah. No, I appreciate you having me. Thanks so much. It's been real.
Real.
If you have any questions, guys, don't hesitate to reach out. As Terri said, it's Clyde The Mortgage Guy. So you can go to ClydeTheMortgageGuy.com and send me a chat. You can hit me up at 404-604-7013. I'm available. Call or text anytime. I'll be happy to answer questions for you or help you any way that I can, even if it's connecting you with somebody else that, to do something that I can't do. So, all right. But yeah, it's a great time to buy property. if you're wondering if it's a good time to buy, even this guy named Dave Ramsey, whose financial philosophy I don't really agree with, doesn't fit my state of mind or frame of mind, don't really agree with him. But he said like 3 or 4 months ago that really now's the best time. And there's no way to tell if it's the best or worst time, honestly. But I can tell you that probably 100% of people that bought a house 5 years ago when they were talking about how bad the market was are in a better financial position now than people who did not buy a house 5 years ago. People who bought a house 10 years ago coming out of the big recession, the market was bad, all these things. Those people are probably in a better financial position than people who did not buy a home right then. Do you mind if I share just a quick story about my own personal? So I bought a house a few years back for $153,000. I sold it for $240,000. And I mean, it wasn't some just out crazy huge amount of money, right? But I mean, 90 grand's 90 grand, right? Yeah, I had to have a place to stay anyway. It was less expensive, or a little bit less expensive than rent for me. But even if it's not, like you gotta play to win, if that makes any sense. So unless you're doing something else with your money, you probably should buy a house. So I sold that one for $240,000 and bought another place for $420,000. And then that place has grown tremendously. Like I say I probably have, and not through anything I did, just through the market movement, probably 300 and some change in equity in this place now. Maybe 275, 300, 350, I don't know, somewhere like that. I haven't run a CMA on it recently. I do use HomeBot though. If you want to be in HomeBot and you want to find out values, it's a good tracking thing for you, but Terri can give you the real deal. She can pull all the comps and give you the personal input. But anyhow though, so that's just my thing. Buy a house, whatever the price is that you can find, and then build from there. You don't have to buy a $300,000 or a $400,000 house the first time. I bought my first one for $153,000, sold it for $240,000. What's that?
So they were trying to reach us already. My phone was ringing.
Yeah, gotcha. Yeah, so 153, sold for $240,000, then bought $420,000, right? Like you don't have to start at the top. You can really start at just wherever you can get to. Start climbing there. If you're 3 foot tall, you got to start at the 3 foot tall like spot on the climbing wall, right? If you're 6 foot, you can start at the 6 foot, but start where you are, wherever that is, and you still got to climb. Everybody's got to climb the same mountain, right? But you start where you are and you keep climbing.
I'm glad you told that story, because one thing I teach all of my clients when coming in here is you're buying for today. You're not buying for forever. You're buying for today. The interest rates don't matter. If you think the houses are too expensive right now, all of that is just what we feel. What if they go up? What if things change? Buy for your needs today. You don't have to buy a mansion on your very first house. You buy what you can be comfortable in. And the key is home ownership, not paying someone else's mortgage. So I absolutely love that you shared that story with us. And listen, I've got one more thing you have to talk about, because it's the lighter side of life. Y'all should follow his TikToks, because he barbecues on the TikToks and I laugh and it looks so delicious. I'm jealous. I gotta come eat one day. But
you do need to come up here to Monroe. Yeah, for sure.
Visit you and see you and Brianna. But yeah. How did you come about doing the whole barbecue thing?
So it's really funny. So really it's really thanks to God. So like I go to a church right here in the Atlanta area, and they asked if I could help with barbecuing. So I've enjoyed barbecuing. I like cooking. My dad was a cook in the military. So we all grew up cooking, but I started barbecuing more. And I used to do a thing I used to do a big thing about bacon. Used to be really well known for bacon. Like, so Clyde The Mortgage Guy, they were like bacon. So I did a bacon and home buying thing, and it just kind of went defunct because of COVID. I didn't really follow up with it. I didn't do too much with it. But barbecue and home buying. So I started doing it because the way God opened up through church and kind of God did a thing there. But yeah, I was like, wow, this is really great. So I went with barbecue and home buying because you kind of have to own a place to really barbecue.
You don't want to burn the balcony.
It's kind of like a hybrid thing now, like in my mind, and I've got to be more consistent with it, right? But I've had a couple of guests, and I'd love to have some more. But so the barbecue and home buying, you kind of need to own a home to barbecue correctly. or know someone who does, because you can't cook on the porch at an apartment complex. And honestly, you deal with rental properties, right? Do they like you having like flames outside of their invitation homes? They don't really like that stuff, do they? They're not really with it. Yeah. So you kind of have to own a place. And then also I think that you can eat for a lot less at home.
Yes.
So if you're looking at, I own a home, but man, I'm really pressing my budget here, like, because I want to buy, again, not the highest home, but at least something, right, that I'll be comfortable in. Well, man, I want to show people how they can cook things like, and you can cook a pork shoulder. You get it for 99 cents a pound at Kroger. You can cook one pork shoulder and eat for a week. You know, maybe you put it in the freezer, but you can make tacos with it. You can make barbecue sandwiches with it. You can do all kinds of stuff. So that actually became part of it too. Because you can go shop at Sam's or Kroger or wherever you can find a good price, right? Started looking at buying whole cows and half cows and things like that from some of the farmers. Those aren't less expensive now, though. They've kind of gone.
Oh, it's not cheaper?
It's not cheaper in most places. If you want to look at one, we can see in Alabama, there's some farms that are a little bit less expensive, but most of the ones here in the Atlanta area, they're the Georgia markets. They're for 4,000, 4,500 for a cow, which is fine. If it's good meat, supporting local, I'm here for it. But again, if I'm going with the budget angle, like hey, stay tuned for that, by the way. I'm gonna get like a chuck roll. I've got a chuck roll, so it's like a whole 30 or 40 pound thing, right? And you can cut it up and you can make like grind for burgers, and there's like some different steaks and stuff in there. So I'm gonna show how to butcher one of those. That way, again, you can get it for like $3.50 a pound, and it's got like steaks and all sorts of stuff in it that are way more expensive. Way more expensive if you bought it. Yeah. Yeah, if you bought it whole. So yeah, I appreciate you asking about that. Yeah, I got to throw some ribs on here soon too. I just got a new seasoning that I need to try it out and see how it tastes. Because we're gonna be using it for some stuff here soon. But yeah, no, man, if you guys have any questions about barbecueandhomebuying.com, or you can hit me up on TikTok at barbecue and home buying. It's still Clyde the Mortgage Guy, but barbecue and home buying is my handle. I'm on Instagram too, Clyde the Mortgage Guy. I'm on Twitter. I don't ever get on there very much. Clyde the Mortgage Guy as well. I need to get on there and actually send information out and post videos about the things. But yeah, no, yeah, please check me out. If you have questions about barbecuing, let me know. I've got some rubs that I can recommend, or different things that you can get that are like, there's the second best cut of meat for a steak. It's like this little tenderloin thing. It's like from the shoulder though. It's called a Terrace Major. Man, I never really knew what it was until a couple of months ago, but it's basically the second most tender piece. You can cut it with a fork if you cook it correctly, and you can get it for like $6.50, $7.50 a pound. Like, whereas you're getting a filet, you're looking at 15 on sale for the whole thing, you know, and if you're not getting on sale, $22.99 a pound. Like, yeah, I mean, golly. So yeah, that's cool. I'm glad you asked about that. I really enjoy cooking. And again, there are a couple of different things. How can you own a home so you can barbecue your own food, right? And then how can you save money by barbecuing and cooking at home to help keep your budget in line? Because yeah, even if you bought a home a year or two ago and you already own a place, then you may be looking for ways to help slim down the grocery bill, because groceries have gone up for sure. So
Glad we got to run out of here and go show some homes, but I thank you so much again for being on, and we'll chat with you soon, okay?
we appreciate you, Terry. Thank you so much for having me. Y'all have a fantastic day.